Hello, I'm Richard Crump and welcome to this latest Financial Director web seminar in association with Concentric Solutions and Oracle. Today we're going to be looking at the conflict between a fast and effective financial close and the requirements of financial governance. The need to complete accounting cycles and produce financial statements quickly and with quality is emerging again as an important requirement for today's finance functions. But with greater financial governance obligations being heaped upon most companies, the result is that this process is often time-consuming and labour-intensive as part of the effort to ensure the quality of financial data. Now, joining me to explore what is required to meet these tough reporting standards, whilst actually reducing compliance costs, cutting the closed cycle itself and demonstrating central ownership of the numbers, is Andy Blackstone. He is the Corporate Finance Director at M&C Saatchi. And we have David Watson, who is the Commercial Director at Concentric Solutions. Just before we begin, I'd like to do a short bit of housekeeping. On the screen in front of you, there should be a facility to which you can put some questions through to our panel. So if any points you want to make about your own experiences with the financial close cycle and any problems and difficulties you may have had, please put them through and we'll try and answer them during the course of the discussion. Now really, I'd like to begin just by, David, if you can give a very brief outline of Concentric Solutions, what you do and where your expertise is.
Okay. Good afternoon, everyone. I'm a director at Concentric, and our background is in financial close solutions. I've spent the best part of 20 years operating in the space myself, formerly with Hyperion Solutions, the company acquired by Oracle, and more recently with Concentric. And our key expertise, I say, is in the implementation of Oracle's technology in this area.
And Andy, if you could just give a very brief overview of M&C Saatchi and, more importantly, what your actual reporting process and reporting framework is and how you currently consolidate your financial and operational results.
Yeah, M&C Saatchi is an international marketing services group. We're listed on AIM. We've got about 77 companies across 19 locations across the globe. In the last 2 years, we've increased those locations by about 6. Really, our reporting at the moment is in Excel, and we're busy putting in a consolidation system because Excel spreadsheets are no longer working and functioning.
Okay, and is that a common problem? You've heard about Excel not working and functioning properly?
Yes, absolutely. I think the Excel is the common answer to most companies' consolidation and reporting problems. Unfortunately, although it offers a number of benefits in terms of ease of use, familiarity in terms of people understanding how to actually get the best out of it, flexibility and so on and so forth. The flip side to that are all the usual problems around control, it's error prone, and it's not efficient from a process perspective.
Okay. And have you found is that ability to use Excel being even more stretched by some of the demands when it comes to financial reporting that have been heaped on FDs, and maybe you can talk about what kind of demands they are and how you've seen that impacting that process?
Yeah, well, I think if you look at, it depends on where certain organisations are in their what I call their life cycle of reporting, because I think as organisations have matured in terms of their approaches to group reporting, you're seeing the introduction more of a systemic approach rather than the use of Excel or equivalent on its own. But I think if you look at the starting point, you have what would be, I would call a management reporting cycle, which is a monthly reporting pack that will have monthly actuals, budgets, forecasts, etc., as a regular reporting stream of information coming into head office. Equally, that might be down to sort of weekly reporting cycles as well, and Excel is an ideal tool in terms of that flexibility to facilitate that. Aligned with that, you also need to look at, how do we report the statutory numbers? And what we tend to find is there'll be a separate set of reporting packs in Excel for the stat numbers, a separate set of reporting packs for management numbers, and now when we look at tax reporting, the introduction of IXBRL, the pulling together Microsoft Word information and Excel, it's becoming a bit of a haze as to how best to actually tackle that from a starting point.
And Andy, have you experienced the haze? Has this any way kind of impacted the way you report? Does that sound familiar to you, that kind of problem?
What David said is completely familiar. I mean, we always have our statutory reporting separate to our management reporting. In part, the problem with the error proneness of Excel is you need two sets of reports to check against each other to make sure both models are working properly. On top of which, there are so many ad hoc reports you're doing, which you hope people are doing. And there's lots of ad hoc reports people are doing, which you hope they don't do. So there's a lot of haze, and there's no visibility at all on Excel.
Okay. And David, what could be done to provide more visibility if that's failing?
Well, I think from a starting point, I guess, no one's saying ditch Excel. I think Excel is here to stay, regardless of, what the technology vendors might want to profess their solutions offer. I think what we're seeing more now is a trend towards the integration of that sort of technology within more of a governance framework that's underpinned by the technology provided by the likes of Oracle, for example. And I think from a, line of sight perspective, from a head office standpoint, I think the importance here is to actually look at the quality of the data that's coming in from the sites. I think there's this sort of pressure around fast close. At the same time, there's the pressure around governance and the quality of information. And it's how do we actually meld the two together? And that has to be managed in a manner where we can provide the right tools to the right audience within the business. So I think you will see, all sorts of options from the Oracle suite that would cover all manner of different areas of what I call the extended close process. I think if you're looking at the starting point for that cycle, though, you have to look outside of what is just consolidation. So you can look at this as being the consolidation process in isolation that leads to reporting quite often in Excel again, or whether you actually look at this from a starting perspective in terms of, well, actually it starts in the sub-ledgers and the ledgers, and that feeds through integration into a consolidation system of one form or another. And that's where I think you can start to make immediate step changes and benefit in terms of automating much of those tasks. It doesn't mean to say you have to do away with Excel, but you can provide more of a control framework around how that gets uploaded, validated, the data gets cleansed and so on and so forth into a format that's more acceptable for the start of that consolidation process.
Okay. And sort of how have you taken a view of consolidation, and how do you see it as being more than just consolidation?
Well, if you see what are we trying to achieve by consolidation, we're trying to achieve information which we can act on. We've just gone through, the present environment says, how often do you have to report quickly? Banking and finance covenants come up. Are we inside them or not as the situations come? We went through a 2007 crisis with the issues of what happens if one of our banks go under. And so just trying to extract that information from our Excel spreadsheets wasn't there. And the basics necessary, underlying pinning wasn't there. And what Dave was almost saying is you're trying to get that good structure underneath, and a robust structure, so you almost know what you've got there is what is there, rather than maybe someone may have just typed it in and it hasn't got any backup.
And how is trying to integrate that information, how has that impacted on your close cycle and the speed of close? Have you found it taking longer, or how do you keep a handle on keeping things quick and efficient?
Well, for quick and efficient, it depends where your focus is. For us, our focus is actually always forward and focus, and making sure that our historic data is matching to what people are saying. So in some ways, by focusing on what we're expecting to happen and it's just comparing and contrast, that cuts out one of the process. We are going through, as I say, putting in a consolidation system in, which we hope will speed things up, but more importantly, make things more efficient and more safe for the finance director.
And can you just elaborate on what those numbers are, these forward-looking figures that are so important to your business?
We use forecasts, but also if you start going to statutory accounts and you start going through all the IFRS decision-making points, the only way you get some of your numbers for your consolidation for IFRS 2, share options, for financial assets, you're trying to do some sort of forward valuation. For intangible assets like goodwill, where you're trying to estimate, do you have goodwill there? Or it's all using forward information. And so in some ways you're using forward information to forecast the business and how it's performing, but also then using forward information just to work out what are the values which you need to plug into your statutory accounts. And those can affect your bank covenants.
Okay, and when it comes to providing, this obviously forward information seems very important to finance directors. So you said obviously not just being about consolidation, being about the forward numbers. How can that be achieved? How can people like Andy be assisted?
I think for what we're seeing as a consultancy is more of a convergence between management and statutory reporting anyway, in terms of the alignment of chart of account structures. I think the systems that we implement still need to service a requirement to provide a management view of the world at the same time as doing IFRS statutory numbers. And I think there's been a lot of focus around the rigour that goes towards producing and filing those statutory sets of books, if you like. And it's only now that it's becoming, as Andy was saying, it's becoming more obvious to the outside world that actually managing analyst expectations in terms of the numbers you're forecasting is just as important. So I think from our perspective, it's providing tools that will allow you to actually take a set of numbers off of a web-enabled central repository that gives you the drill-back insight as to where the numbers have come from, right through to ledger. But the opposite way is also saying, how do you align that in the true context of enterprise performance management solutions? How do you integrate the consolidation process with the budgeting, planning and forecasting cycle? And a lot of that's due to, do you build your forecasting system in the consolidation element of how you report, or do you have a separate budgeting, planning and forecasting module that aligns with the consolidation process? And we've done both. I think it depends on the granularity of information you want to capture. It also depends on how much of it you can automate within the consolidation system. As to the follow-on from that would then be, can you drive a forecasted balance sheet off your working capital analytics, etc., or is that going to set more in your budgeting and planning system? So I think there's more of a convergence of technologies. There's more so a convergence of thinking, I think, in terms of the reporting models that are being designed and built, where more and more customers are expecting to have the cake and eat it. They want it all in the one system. They want this sort of one version of the truth, right from source through to filed reports. But as we've been saying, I think that now extends beyond just consolidation and reporting and into budgeting, planning and forecasting.
Andy, do you want to have your cake and eat it? Do you want everything in one system?
No, we don't have our cake and eat it, partly because you're dealing with lots of different business units. And if you just look, if we're starting to talk about forecasting and sales order cycles, each different business unit has a different visibility on their future sales. Some of them may be on project-based, which are relatively short-term, and some may have longer-term projects, which really, they know they could tell you a result next year. Unlike, if you're a company which is just letting in properties, you know what's going to happen next year. You could write your P&L statutory accounts for next year almost now, providing nothing major happens. So there's a vast variability in organisations.
And I think from what we're also seeing as well in terms of breaking down this closed cycle and the sort of governance theme, if you like, into its constituent parts, you have what we would see as being three broad phases of reporting. You have your sub-ledger and ledger close process, and that comprises everything from the transactional feeds and input to the adjustments, prepayments, accruals that need to be organised, and that ties in exactly with what Andy's saying there in terms of that needs to be flexible enough to be handled in a manner where it can vary by business unit. It doesn't, however, take away the need to be able to control that process in order that you can track towards the mantra of fast close. I think there needs to be some acceptance that there are stage gates that each site will go through in terms of producing those numbers and actually getting to a point of understanding as to what is the outlook and what day do we have to submit those numbers on. So I think we can help in terms of addressing some of those sort of challenges in the context of Oracle's financial close management solution, which provides an overlay framework that's in effect a process monitor that allows you to actually pick up the thread around, who should have reported what by when, and have they, and where's the bottleneck and what can we be doing to make that process more efficient. So I think it's a continual challenge, the flexibility of being able to cater for different lines of business that may have different metrics that they report on, but at the same time, group still needs to file a set of reports within a certain deadline.
Andy, where do you find the bottlenecks exist within your own sort of close system?
It all varies. I mean, the key thing is the unknown unknowns. And you're trying to work out who's causing the problem. I mean, I'll just use a classic one of a competitor of ours who had a nightmare with intercompany reporting. Now, people have been ticking it off, but actually when it got audited properly, they discovered a great big hole in it. And that's my biggest worry with the Excel spreadsheets, is someone's going to say, yeah, it's okay. But you don't really know, and you can't drill down, and there's nothing on the system which is telling you otherwise.
Well, I think again, if you look at the history of consolidation systems, intercompany is a key element of the value proposition for implementing a system of that sort. But even then, looking at it as a point solution in its own right is no longer good enough. You need to look at it from the standpoint of the process and how that fits with the business. So the business, if it's used to using Excel, overlaying this new system on, it's not necessarily going to be readily accepted without understanding how it works with the people through their finance process. And I think it's what we're seeing now is more of almost a phased submission approach, where we're encouraging customers to look at a pre-close for the likes of intercompany, so that the sites can actually publish their balances with each other on a centralized, web-accessible desktop. Then when you hit your main closing cycle, they've already reconciled most of the issues that come out of that, matching and elimination process. And broadly speaking, we would expect most of those to be processed automatically in terms of eliminations. So I think that's again is a key tenet of moving off spreadsheets into more of a true consolidation system. You should expect any decent consolidation system to offer you that facility. And what's more, you shouldn't have to wait until you've done the consolidation to work out what the intercompany mismatches are. It should be in a position to offer you that information as soon as it's been entered.
Okay. And the consolidation, of course, isn't just about the systems. You talk about company mismatches. What other kind of mismatches can take place that aren't directly related to the system itself?
You get a whole host of reconciliation challenges, especially if you go down this single stream route, I would suggest, in terms of trying to align your statutory and management reporting processes. That's further complicated by the frequency of reporting, I would say, as well. And especially in the spreadsheet world, I think there is a tendency to limit the reporting to as few periods as possible, because the overhead on the business of actually asking for the data in the first place is a challenge. So I think, putting in consolidation and reporting systems is a good step towards moving away from the fear of actually collecting the data that's needed for reporting, but equally also putting the tools in place to help that reconciliation process. We see a lot of examples of where a management hierarchy may be, broadly speaking, different from what you'd see from a legal hierarchy in terms of representation of the business. So how do you manage the adjustments that are actually processed on respective structures if you have a common model? I think those are typical things that we can help a customer work through as a business. And I think there is no reason now why you shouldn't be able to actually put in place a degree of automation around that as well, in terms of certainly the automated consolidation adjustments as part of that reporting cycle. So I think the sort of challenges in terms of mismatches tend to be down to the quality of data question again, in terms of how transparent is it? Can you drill through back to source? And if not, where's it come from? What's happened to it en route before you actually start looking at it in the system? So I think it's as much about control and process as it is about systems.
Okay, and does that ring true of you? What kind of mismatch reconciliation challenges have you experienced?
Well, in reality, when it comes down to things like year-end, is you hold your breath until you've reconciled every single account on Excel. It's not automatically done. Even when you're reconciling things like share capital and goodwill, because there's a bunch of eliminations, you also rely on people understanding their journals, and it's almost it's locked in someone's head. So you've got this huge risk of what happens if that person who's got all the information locked in their head is knocked over by the Clapham omnibus the next day as they go home, which is a pretty heavy corporate risk. So automating and putting it into a quite systematic method sort of reduces corporate risk. The other where I really see risk is when things change quickly, or if you need to close halfway through a month for some reason. Some corporate transaction lands on you. You need to pull out the data quickly halfway through the month. You need the system coming in. And sometimes you don't want to tell anyone where we're up to and what we're doing. So essentially, you want that data almost fed through automatically.
Excellent. Well, hopefully the systems we've been talking about mean you won't go too blue in the face, holding your breath. David, one of the things you mentioned about earlier was about the idea of control and control of the process. What happens maybe when something goes wrong? How do you reconcile that with the closed cycle process if wrong information is added or something goes wrong halfway through the chain?
Well, I think it depends on what's underpinning that process. In terms of systems. I think if in an ideal world, we would encourage customers now to look at software which would have a degree of what we call process management attached to it. And what that means is, in effect, you make the individual task owners responsible for the data at each stage in the process. So there's that segregation of duties in terms of ownership of their data, right down to reporting site level, not necessarily talking just about group. So that then encourages more of a culture of getting it right first time, for a start. Equally, when the data actually flows through to head office, you can include certain what I'd call review layers in terms of stage gates or control gates, where once the data has actually been reviewed, or rather even before that, once the data has been collected and or uploaded or entered, it can then be reviewed and then signed off and approved before it's promoted to the next line manager. He can then either approve or reject it, and so applies a degree of control straight away, just in terms of what's being submitted. At a more fundamental level, and that can flow right through to head office in terms of lines of control. But I think at a more fundamental level, coming back to data quality again, it's such a key driver for the success of a consolidation process. I think if you get it wrong right at the beginning, the process dependencies further down the line, you end up in a restatement position because actually we got this bit right at the beginning wrong. So I think as much of it is about actually getting the data cleansing right, being able to verify what you've got is actually what you need, and also being able to validate that in a manner that actually makes sense for that particular submission. So not just a summary set of validations that happen to be the only ones we've come up with that are common, but actually a set of validations that can push that level of control into individual users or owners of the data, and making sure that it's right first time, to say. So I think that there's the data cleansing and verification piece. There's then the workflow element of it in terms of submitting it to the next person for sign off and so on and so forth. Especially the advent of Sarbanes-Oxley in the States, entities that have US filings now as well. It's expected that an electronic signature takes place in terms of that approval of data as it flows through the business. So that's all available now, something that you wouldn't be used to in spreadsheets, short of actually someone autographing it as part of that submission cycle.
And Andy, just thinking on the pressures on controls, have you ever experienced like an increase in the pressure to show that control? I don't know if it comes from HMRC fines for getting things wrong.
Well, we've got associated. I suppose you could say this is a year of a senior accounting officer. So a finance director, or somebody in the company has got to sign on a dotted line, and get a potentially £10,000 fine per UK company. So with us having 25 UK companies, you can quite easily work out how much that fine could be. So that's one personal, quite large pressure, which I don't really want to remind my wife about. But the other side is when things go wrong, it's going to land on the finance's plate. And it's quite interesting what you're saying, David's saying about controls. And I think one of the advantages with more consolidation system is often our controls we do ad hoc with ad hoc spreadsheets. And we learn them as we go along. And to be able to re-input those into a systematic format in a single place, so it can go back to source, it would be far, far better. And we're seeing with the consolidation project is not having to rely on reconciling again and doing these controls at year end and checking it. We've gradually been doing that every month, so the year end becomes faster and faster. And this is another reason why we're putting in the console system.
I think the key message around that as well is as much about not just the transition from Excel to a consolidation system, but also about the opportunity to look at process and policies and procedures and the governance around that, and then being able to actually put in place some form of process monitor that actually keeps the users honest in terms of what it is they're actually submitting through to head office, so that the FDs have that line of sight down to where each individual business unit is in the submission process. And you're always going to get this situation where you have your favourite 2 or 3 entities that are always late in submitting. You know who they are before they've even submitted. But nonetheless, it will give you that extra degree of insight as to where the bottlenecks and process efficiencies are that can be gained by implementing a system of this sort.
And is that line of sight essential for FDs to actually have full ownership and accountability for those numbers? Without that, is it very hard for an FD to take the ownership that's required?
Well, I think it is, but it's not just the FD. I think the FD at the end of the day ultimately signs it off. It's about a chain of custody, right down to, if you consider it a reporting value chain right from the beginning through to published accounts. I think it has to involve each stakeholder in the process. I think the FD's ownership of it is about making sure that those policies and procedures are being adhered to, and that you can see evidence from an audit perspective of how that's taken place on the process towards getting a pack of reports on his desk. assuming that those are repeatable processes in a manner that can be audited. And as I say, most of the systems now that we look at implementing have huge amounts of audit trail functionality around them to actually give that level of assurance. You know, both from a journal perspective, but from a data entry perspective, but also from a system change perspective as well, which is again a differentiator from what you'd have on the Excel view of the world, where there's no record of who's changed what when. So I think, you know, having that at your fingertips is a step in the right direction, but it's about getting the right people in the chain of reporting to sign off as they go on. So this idea of promoting data to the next manager, you might only have 2 or 3, it might be a very short chain, right up to the FD's desk, but in some larger conglomerates it could be as many as 6 or 7 chains of sign-off before someone's actually said, yeah, I'm happy to file this.
Okay, I just wondered how many links you might have in the chain, Andy, and what you do to obviously make sure that you have the ownership and the accountability for the quality of the data and the processes being used in your closed cycle.
For us, at the moment, we're using quite a few sub-consolidations just to keep the numbers down at the top level, consolidation level. Our key method to keep validation, oddly, is speaking back to local CEOs. We get the reports out, we interpret it, we then speak to the CEOs and get their interpretation of their own data and make sure the two tally. And if they don't, we might have to get them to submit again, if necessary. So I'm always a great believer in actually picking up the phone or going around to someone's desk and speaking to them. And in some ways, the key job of finance director is making that next level of interpretation. And a lot of stuff we've been describing is what I call a job of the financial controller, to make sure the data is valid, etc. And then allow the finance director to interpret, discuss with the board, and discuss with local CEOs and try and move them forward and put it right, not necessarily data right, but get their numbers right.
And have the things we've been discussing, would that alleviate more time for you? Would that give you more time to do the interpretations, which is the requirement of the finance director?
Yeah, but the key thing is one, it's leaving time, but it's more making sure you sleep at night knowing the data you've got is true. Mm-hmm. Yeah, the big worry is, and it's easy enough done, anyone can put any data they like into a system. Yeah. And it's making sure it's valid, it's backed up.
I think again, what we see just from a submission cycle standpoint, you know, I think you end up with, in the Excel view of the world, is a very sort of detached process, and it's almost seen as something that, well, that's head office's problem. It's not the reporting site's responsibility to get it right. When in fact, you almost need to design the whole consolidation cycle around what you want out of the reporting process at the other end, rather than use the ledger to drive what's actually coming in at the bottom end. And assuming you've adopted that mindset, you very quickly start to realise that actually each individual user further down the chain has their own part to play in the process of actually ensuring governance around the data submission. And I think from a, you know, efficiency perspective, I think we need to actually look at ways and means of allowing companies to report more quickly, in the sense that what we regularly see is, we talked about forecasts earlier, sometimes some of the reports we see that are so-called forecasts, you know, they're out of date by the time they actually land on the person's desk. You know, it needs to be relevant information in terms of the reporting pack design. We worked with a large steel conglomerate, and we took 2 weeks out of their monthly reporting close cycle and saved them 30-odd man days of head office time in each reporting cycle, just by looking at what is it that matters, you know, in terms of, you know, what do you actually want to report. And we got their, you know, reporting volumes, which we uncovered. We highlighted this spreadsheet underworld of about 4,000 reports, which we've managed to condense to about 300 system-based reports that gives them pretty much the same information that they need to run the business. We've then looked at condensing 3 or 4 separate consolidation systems into one, going single stream, put in place this idea of this process control and process management to actually promote the data. And it's now bearing fruit in terms of how they see the data that's coming through from the sites. It's no longer seen as just head office data. It's seen as being data that was owned by the reporting sites and has some governance around it.
Well, Andy, I'm just thinking about the spreadsheet underworld. Sounds like quite a horrifying place. Hopefully, I don't know if there's anywhere you've ever felt you've been, and what you've maybe actions or how you've tried to emerge from that to maybe the spreadsheet heaven, if there was one.
No, there's always oddly going to be in a spreadsheet underworld, because someone's going to ask you the ad hoc question and you're going to create a little spreadsheet to do it. It's trying to eliminate and make sure everyone understands it. And my bigger risk on Spreadsheet Underworld is only one person understands that spreadsheet, which might do something mission critical. And I remember years ago being in an organisation, and it's nothing to do with accountancy, but it's a purchasing guy. A 21-year-old got knocked off a motorbike. Complete mess of all the group's purchasing in that previous organisation because we didn't know where we'd been buying from.
Do you know what? I think we've spoken about quality, we've spoken about speed, we've spoken about ownership. I'm very surprised, we're coming towards the end, and we actually haven't spoken about cost, which, sat with a finance director to not talk about cost seems like a remission of duty. So I'd like to talk about that very, very quickly, about how, maybe the impact of complexity of reporting requirements, what that means for the cost of compliance, and how these processes can get the cost of compliance down. David?
Okay, well, I think from our perspective, cost forms two broad components: internal resource and external resource, in a nutshell. You've got the internal people that prepare the reports in the first place, and you've got the external audit obligations in terms of, how much do you spend with your auditors actually making sure that the numbers are what they should be. So I think from our perspective that now is an additional challenge, especially when we're talking about IXBRL and tax filings and so on and so forth. You need the tools at your fingertips to be able to process, and has in effect become an extension to the close cycle, process those sort of HMRC filings in as automated and as robust a fashion as possible. So I think the cost, as we see it, tends to be in some ways resource related, but also in terms of, I talked a moment ago about the frequency of reporting as well. The cost in itself becomes a detractor to how a business reports. If you can streamline the consolidation process, you can streamline the data integration process that precedes that, then if you can automate all of that as well, then you can start asking your sites for more data, and you can do much more with less. And if you have the data centrally, then when you get to the back end of the reporting process itself, the cost of actually producing those reports becomes much less because you've already got the information there. It's just a question of how it's then provisioned to the different type of user. So you might have a dashboard for an exec, you might have a set of production reports that are repeatable reporting templates that can be run, so not Excel packs, that are system generated that can reflect one version of the truth across the business, right down to ad hoc reporting tools such as Microsoft Office integration and query analysis tools for the analysts, where Andy might go to a colleague and say, I don't like this number this month, why has it changed? I need to know in the next hour. You don't want to have to go and phone the IT department to have to run a batch process before you can get the answer. So the cost of consolidation and reporting is partly resource, but it's also how much have you managed to automate.
But how have you experienced, what's your cost? Have you seen the cost of your compliance increase with things like IXBRL, and do you see this as a way to take that out?
I know. IXBRL at the moment I see as a known unknown. HMRC keep moving the ballpark, and we've just got to the point of saying we've outsourced our IXBRL situation for 2 years, where we've worked out exactly where the playing pitch is. As far as the general cost of compliance, and actually the curious thing, I can flip back to IFRS 8, which is basically saying we segmentally report, and we have to tell the market how we should report to management. And you report to a city, how you report to management. That's quite interesting on organisations to see what numbers everyone's focusing on. And so suddenly the management accounts and the stats accounts come together. The key thing I actually found with putting these systems in is re-examining what we've been doing. And over time, you keep building up spreadsheets, as you've been mentioning. You can harvest some of those spreadsheets. And there's probably errors in those spreadsheets which, after 10 years of using the same spreadsheets and adjusting it, have crept in. And they just get too big.
Okay. Just before we move on, I've got a couple of questions maybe from the audience to go through. The first one is, what is the best practice in producing management accounts from the financial systems and data? Maybe David, if you want to take that.
Well, I think the first thing you need to actually address is what are your management accounts? And that may sound like an obvious question, but I've visited organisations where the management accounts consisted of 12 reports, and I've visited other organisations where, as I mentioned earlier, there's thousands of reports. So I think there needs to be a baseline drawn around what is it you need from a reporting output perspective. You then need to assess what is the lowest level of common detail you're going to need for the different types of reporting that you want to do. Because the mantra I would be playing to here is load once, consolidate in different ways several times if you need to, but don't ask your users to enter data more than once if it's the same information. So it's about getting that level of depth correct to start with. We talked about intercompany. Another example is you might have differing standards within the business in terms of how you would match and eliminate intercompany on a management basis versus statutory, your legal obligations. Doing that in a disconnected fashion and ending up in a position where you didn't capture the data at the right level of detail to start with, you start introducing the need for manual adjustments rather than thinking through what you were going to need further down the line.
Okay. I'll just go through a secondary one. So hopefully I'll trumpet this one to you, Andy. It's assuming that fast close and local data ownership is considerably helped by provisioning an end-to-end solution from ledger to consolidated reporting. What are the main challenges in providing an end-to-end solution? Do you think that's IT or cultural?
I think a large portion of everything is always cultural. It depends, obviously, the size of office and central control. Yeah, if you're decentralised control, then the only way to get end-to-end processes is to get local ownership and local buy-in. If you're centralised, it's probably easier. You just tell them what to do and they do it. The system side of things, well, oddly, I think once the culture's sorted, you could actually get away with redoing everything on an Excel spreadsheet, as bad as it sounds, but completely from scratch upwards. But in some ways, I think the systems create a bit more rigidity and I think a longevity in the process.
Okay. Do you have a view on cultural versus IT?
I think from what we tend to come up against regularly is a bit of a disconnect again between the reporting sites and head office. As you would anticipate to some extent, if you're going to roll out a new system, unless there's been more of a communication plan to the stakeholders in each of the reporting sites, what we quite often see is that sort of aversion to change in terms of, well, we've always done it this way, so why are we changing sort of attitude, rather than looking at the bigger picture in terms of what are the downstream benefits effectively going along this path. And I think what we see from that context, yes, very much cultural obstacles, in as much as there is a bit of coercion and almost an internal sales job that needs to be done by head office to actually get the buy-in of the reporting sites in terms of the value they're going to get downstream from it. Otherwise, you end up in a situation where, well, we're just doing it because head office have asked us to do it. And you end up with that lack of commitment on the project to actually generate value from it downstream. I think from a systems perspective, it depends on the technology standards that you have in your business, but broadly speaking, the technology we have now is very scalable. There's no reason why you couldn't have one system to handle that sort of wider scale reporting requirements that we've been talking about. But again, the wider the reporting, the more stakeholders there are. And so again, it depends on the types of structure you have as a business as well. We typically will see some businesses with different statutory and management reporting teams, other businesses with a single team. Some people have systems accountants as a team servicing finance. Others try and push the onus of that responsibility of managing the system on IT. So again, it depends on the culture of the business from that perspective. So,
I think we've got time for one very brief question, the final one. This I think is addressed to you, Andy. From your experience in the field, well, that makes you sound like you're an army man, a soldier. No, in your experience in the field, does the technology allow for a truly global end-to-end solution, or are there compromises? If there are, what are they?
I'm unfortunately a disbeliever of the end-to-end solution. I use an experience talking oddly, and so I to use a different competitor, but Sage is a classic one where I've tried to get a nice simple package. Their opinion is we can't give you the same package in every single country in the world, because in Germany and in France you have a nominal ledger defined for you. In England you can do what you like, and we've got Alex Brill on the end. So we're dealing with completely different regulatory legal frameworks. In China, I think you actually have to buy your invoices, and that's how you pay tax. So it's so desperate in countries, an end-to-end solution doesn't work. On the console level and up from nominal ledger, yes, absolutely you can.
David, do you think is there such a thing as a global end-to-end solution?
There is from a focal point of consolidation reporting, yes. And I think if you look at the three areas I talked about earlier, the idea of providing a process monitor over the ledger, sub-ledger close to actually give that line of sight, the idea of having an integrated consolidation module in the middle, and the idea of having a suite of options in terms of how you automate the reporting output depending on the type of audience at the other end. There's absolutely no reason why that can't be multilingual, why it can't be multi-gap, why it can't be multi-platform as well, in terms of whether it's a reporting to a Microsoft Office audience or whether it's actually someone who's going to be looking at it on their iPad, for example, in terms of seeing some dashboards on their phone.
Okay. Well, I hope you've got a lot from that debate, and I hope it also means that you're not going to, your company or your finance function does not live in the spreadsheet underworld. So really, it just leaves me now to thank my panellists, Andy and David. Obviously, thank you for your questions and for watching. I've been Richard Crump, and I look forward to seeing you next time.